Hello, listeners, and welcome to the Montel Weekly Podcast, bringing you energy matters in an informal setting. This week, we will delve into the world of robots and algorithmic trading. AI has been making headlines this year as it is set to make huge inroads into our daily lives, with new developments occurring almost on a weekly basis. Robots are well established in financial markets, but how prevalent are they in energy markets, and should energy traders be worried about their jobs? Joining me, Richard Sverrisson, to unravel the world of high-frequency algorithmic trading is Amani Joas. A warm welcome to you, Amani.
Thank you very much, Richard.
Can you just tell me a little bit about yourself and your role and the company you work for, Amani, just before we get started?
Of course. So my name is Amani Joas. Thanks for having me again. I am working as managing director as one of 4 co-founders for a company called CF Flex Power. We're quite new in the market. We were established 1 year ago, and our focus is in 3 areas. We do route-to-market trading for renewable assets. We do what we call flex trading for flexible assets, mostly batteries. And we also just launched a platform called Power Match for standardized, or as we call them, liquid PPAs. And my background is in energy trading. We have been on the short-term markets as a team, I think, with one of the longest track records, with a focus on the continent, especially in Germany. And the 4 founders were like the core trading team at one of Germany's biggest trading companies that got acquired by Shell. And then we had a good chance to venture out on our own, and we like what we do, and we do what we like. So it's been going very well.
So you're very much an expert in the field of short-term trading and the slaves to the algorithm, if you like. Let's start by talking about these robots in short-term and intraday markets primarily. How prevalent are high-frequency trading algorithms in these markets that you're dealing with?
So the markets that I would focus on today is really short-term trading of power, more so than gas. These are the markets usually on the big exchanges are Apex and Nord Pool. And you have the day-ahead market that's run as an auction. You have some intraday auctions depending on the countries. And then you have a continent-wide continuous intraday market. And I want to focus on that market because that's where we have seen the big rise of the algorithms. And there they are extremely prevalent. So over the last 5 years, the growth in positions being closed by algos has been quite rapid. So on EPEX, we see that 85% of trades at the moment are already closed by algos. And about 60% of volumes are closed by algos. The difference comes a little bit because algos tend to trade smaller positions. They're faster than humans trading with their fingers. And the trend is continuing. However, it's important to distinguish, like when you say high-frequency algos, these are not the kind of algos that front-run other people in the massive speed that we have seen on stock markets, but most of them are quite simple automated execution engines. But on this, they have been taken over, but it's a difference to say automated trading or autonomous decision-making. So this is not the big AI revolution that you're seeing. It's more a tool that traders are using.
But we'll talk about more about that later, I think, and also about the future outlook for the robots and these algos. But these are quite huge numbers, 85%, 60%. You know, could we reach a point where it'll be 99% and sort of 80% of the volumes?
Maybe a little less. So I think the trend is going towards that direction. But I do think that there is a role for humans and for manual position closing in the market, as I think we'll delve more into detail on later. But yes, I think we'll get to around somewhere in 95 positions in 85% of volumes being closed through APIs and with algos behind that. That's definitely the trend that we're seeing.
Well, that's quite a transformation then. I think you're very familiar with what you do in CF Flex Power and maybe some others. But are company using them differently? Are these the same kind of algos, or are they you know, I'm a complete novice here, Amani. So I mean, what kind of algos are we talking about here?
So yes, companies are using them very differently, and I think the most important point to keep in mind that there's very different levels of sophistication. So algorithms are essentially a tool and their sophistication ranges from that of a screwdriver to that of a full-scale assembly bot that you would see in an automated factory. And the use cases for algos are mostly position closing of renewable positions on the intraday, for asset optimization, market making, arbitrage trading. So this is where you see a lot of the algos. When it comes to prop trading, I think you still see a good mix of humans and algos that tend to have the best results.
Is there a danger here that the machines, the algos, are all following the same kind of signals? So if you say, okay, there's a sudden change in the weather or a big power plant goes offline, and all the algos react in the same way?
Like the algos do run on similar signals, but also do humans. So we all look at similar things. So when something happens, the market might overshoot a little bit and overcorrect. A classic thing that we see where the algos react a lot is big changes on the balance of the system, or if you have an NFRR call, you see algos going crazy and running into the same direction sometimes. But I don't think it's so much a danger for the system or for the market. It's more a danger for the companies using them and making trades at unfortunate prices.
So then they have to put in the sort of stop signals there, or the stop loss kind of elements. They have to be quite strict on those.
Yes, but there's a danger in that as well, because if you have price limits that are too restrictive, you might not close your position. And that's actually the danger that you're talking about in energy market, is somebody not handling their positions and having large imbalances. So I think when you talk of danger, it's more managing your position rather than, influencing the markets and letting it run wild in one direction or the other for a few minutes.
So the managing of that position, that's when we come into the humans and the behind the machines here, isn't it, Amani? So they're the ones. I'm just going to ask, what is the role for creativity here and human intuition that you have on many trading floors?
So there's a quote that I like a lot by Nassim Nicholas Taleb, who says, "Finance run by technologists is just like food cooked by pharmacists, books written by printers, operas composed by sound engineers, and plane flown by mechanics." So in that sense, I do believe that human creativity still has a very large role to play. And I've heard this story so much over the last 5 years that the times of traders are over and bots are taking over. But when I look especially at prop trading desks and at us at Flex Power, I've not seen an algo desk or a pure algo desk that can compete with the combinations of humans and algos. And, algos are programmed to solve very specific problems in very specific situations. So they tend to struggle when something unforeseen happens. And when it comes to position closing and asset trading, they're quite good. But when something fails in the market and things fail all the time, then human creativity and problem solving still tends to be very important. And I would personally struggle to have a desk that is only run by algos, because I know how things fail and I wouldn't want to run the risk of having a large open position.
I mean, certainly in the last couple of years, we've seen some incredible price movements in these markets for several reasons, of course, but mainly, due to the war in Ukraine and the gas crisis or the energy crisis more generally. And how can machines cope with that?
It usually that comes back to the humans running them. So most algos, again, I think when we're talking algos right now, we're talking 95% automated execution. So the human will set certain parameters on which the algos trend. And problems that we've seen in the Ukraine crisis, and I've seen this on desks, is that you would have price limits that were set too low. And let's say gas prices go up 20 euros, so power price levels go up 40 euros day on day, and you have a price limit that's set too low, and the algo doesn't close the position. Then you're really running danger, because again, they're programmed to do very specific things. Another example that we saw on April 10th, that was Easter Monday, where we had very low demand, extreme sun, so very, very low or negative residual demand. And on markets, we'd never seen really price levels below minus 80 euros, because that's when renewables usually curtail. And on this day, prices went down to negative 2,000 euros. So most algos would have lower price limits at like minus 80. So then they wouldn't close their positions, and you could see some traders panicking and seeing that their positions aren't closed and just going wild and selling it at ridiculous prices. So these are the situations where you might want to have a human in place.
Absolutely. But, it's very interesting, this interaction between human and machine. And a few years ago, we were talking about machines taking over. We're all going to be, as I mentioned, slaves to the algorithm. But it's more the other way around, isn't it? That the algorithms are slaves to the humans behind them.
In the status quo, yes. So I mentioned a bunch of times now that we're talking automated execution. So in that sense, algos really much are your little helper tools that you send out to the market to do very specific jobs. But when we talk about algos really taking over, we're talking about autonomous decision-making and self-learning AI. And if that were happening, like you would have heard about it, because this wouldn't be a gradual change. This would be a complete game changer. And a metaphor that I like on this, because people are looking at very impressive technologies such as ChatGPT. And ChatGPT is a large language model that trained on a specific and non-moving set of data with immense calculating power over a long period of time. Then when you ask it questions, it can use this information to answer flexible questions. But when you think of autonomous decision-making on markets, I think the better comparison is self-driving vehicles. And you know as well as I do that this is a problem that has not been solved, even though the biggest tech companies in the world have put immense resources on solving that. And the difficulty there is that you're in a dynamic environment. Now, when you look at the real world, like when the rules that we set for humans, like an 18-year-old can get a driving license after 6 months of training if they're physically and mentally quite capable. If you think about the sophistication of working at a trading desk, I can guarantee you that getting a job at FlexPower and being a good trader is way more difficult than getting a driving license. And think about, you're driving home and your AI is learning in your self-driving vehicle, and you have a curve bending, into your driveway. That curve is going to be the same every day, and the machine can learn this. And sometimes you will have people there, so you have this complexity. But now when you think about a market, let's say you say your curve is quarter hour 13 Q4, and you learned in that quarter hour yesterday that there's a certain curve, and today or on the next day there's a certain curve in 13 Q4 as well. But in one day it might slope down. On the next day there might be a mountain on this curve, because things change so constantly. And then the really difficult thing is that the speed at which you enter the curve and the size of your vehicle will bend the shape of the curve. Like by making a trade, you're bending the space around you because you're influencing your environment. So figuring that out for an autonomous intelligent engine is extremely complex, and we just haven't reached that level of sophistication yet. And we also don't have the expertise in the markets to solve these problems at the moment. So do I say that this point will never be reached? No, definitely not. But I think it's quite a while away.
Yeah. I mean, as you said, these markets are very, very, dynamic. They change constantly. On some days there can be a perfect storm of factors, a whole cocktail of events that maybe are completely unforeseen, and machines, it must be very difficult for machines to be able to understand and react to that.
Yeah, definitely. And so the big problems that I see on the autonomous decision-making part, one example is just, handling technical failures. So that's often an underestimated issue for autonomous decision-making, because streaming live data and making decisions based on them is complex enough if everything goes well. But very often it does not, like markets have technical issues and break down. Websites for essential input data crash, scrapers fail, data pipelines break, trade collection malfunctions. And all these processes are annoying for humans, but we're quite good and flexible in finding workarounds and solving these problems. But any of these issues would be catastrophic for an AI that handles the large unsupervised positions, as the AI is just not able to pick up the phone and find a workaround.
But how, for example, they're quite well established. I said in the intro that they're quite well established in financial markets, a lot of these algos. But how does that compare to what's happening in energy, specifically short-term power markets, Amani?
I would say there are two differences. One is the level of sophistication. So energy markets, especially short-term markets, are not the markets where the biggest hedge funds in the world have been investing a lot of money, getting the best technical talent to tackle these problems. So the amount of resources that has been thrown at these problems is just lower. And the second problem that you have that is more systemic, if you wish, is that short-term markets, you have every day in Germany, at least, or in the continent, 96 quarter hourly products and 24 hourly products. That's 120 products that are traded simultaneously, or at least until the time they run out. So you're dealing with streaming data and input factors. So decision making is very, very quick, and the volumes are not very large. Whereas in financial markets, you actually might have more time to decide whether you want to buy a certain stock or not, so you can throw more calculating power at a single problem, whereas on short-term markets, you're throwing calculating power at a lot of small problems, and again, you're streaming live data, so this problem just becomes a lot more complex than in other financial markets that we see.
Could you see a role for these types of robots and algos in energy, also in forward energy markets?
Yes, and they do exist in forward energy markets, and I think they're more based on fundamental models where they have more time calculating what they want to do. But on those markets, I'm less of an expert, so I would be speculating a little bit. And then on those markets, what you do see a lot, but you also see that in short-term markets, is where algos have a lot of values in market making and arbitrage. So on that level, they're tech companies that only do this and are very successful.
These machines, these algorithms, automated execution, and they're designed to react very quickly, of course, and they're well-intentioned. They're there to make money for the companies who program them, obviously. Are there any malicious spots out there? Is algos that are not so well-intentioned, Amani?
Well, none programmed by FlexPower, I can say as much.
Okay. Okay, that's good to hear.
So yes, a little bit. I don't think it's a big deal. So at the beginning of the algo trading, we saw some bots that would fan out the order book in very, like, just setting very, very small orders so that you couldn't see the order book properly as a human anymore, which was annoying. I don't even know exactly what their intention was. The people regulating, or the boards regulating the exchanges, got rid of them quite quickly. There's some algorithms that do a bit of spoofing that can also be annoying, but I don't think it's a large issue, because at the end of the day, the way I see it as a trader, if you show a price, you're willing to trade at that price. So you always have the risk that somebody lifts your offer, and if you didn't intend at that price, you also have a risk, and then that's your problem. So, like, algos threatening the market in any way, I think it's well under control.
Okay, and can you just explain spoofing in this context, Amani?
So spoofing would be if you have a spread between the bid and the ask, and you put in higher and higher orders on the bids to have other people jump in front of you to push up the price in that sense. So you don't actually have a buying intention, but you try to push the market into a direction that suits you.
Well, you hinted towards the regulatory oversight, that the exchanges are aware of some of these issues. Is it fit for purpose? What the way that the sort of regulatory environment and the supervision and oversight?
So if you think about it on a deeper level, like nothing fundamental has changed through algos, because from a regulatory point of view, you're still making a trading contract, and two parties come together, or in that sense, you make a contract that's funneled through the exchange. And I'm reluctant. So it's been going well. The process has been moving forward. I'm always reluctant to call for regulation, because oftentimes more harm is done than good. So I don't see a big regulatory challenge there. The big regulatory challenge that I see for governments is more that they underestimate the value of data and of live data and of transparency in helping the market or in helping actors making the right decisions. And that's even more true for algos, because algos may make even wronger decisions if they get faulty input data. So that's where I would want to see the regulator move forward.
And is cybersecurity a big issue? Obviously, you're dealing with very powerful machines, so you have to be completely secure, I would imagine.
Yes, that is definitely a big issue. So if an algo any trading operation, but especially if your algo operation got hacked, that would be catastrophic. So you have to have very secure systems in place. I haven't heard of very big failures there in power markets, but this just might be due to the fact that we're still too small to be relevant at the moment.
You mentioned the availability of data on websites, etc., being bots that scrape the data, etc. Energy market data is fundamental. It's of key importance for companies like yourselves and the availability of that. What's your view of the current sort of state of data transparency in the markets in which you operate, Amani?
From the private sector side, I think it has improved a lot, and companies like Montel or Volue are doing a great job in cleaning data and organizing it better. And again, especially for AI and any sorts of models, my experience when I was working back as an analyst was that 80% of the time is usually spent cleaning and organizing data, and then 20% of the time is spent doing actual analysis. So if you have companies organizing that in a better way, that's extremely helpful and gives us a large push. When it comes to the regulatory side, I think the situation especially on the continent is quite bad. So if you let me take a step back, so for us as traders, prices are just pieces of information, right? And they're used to signal abundance or scarcity, and thereby they influence production and consumption decisions. So if we as traders or also algorithms act on information that is incomplete, incorrect, or untimely, decisions are made that don't help the efficiency of the system as well as they can. So the availability of data is very important. And when I look especially at Germany, I think it's a third world country compared to the UK when it comes to data transparency, where in the UK a lot of live production data is published. And the perfect example of this is the state of the grid balance, which is published in real time in the UK and is published in real time in the Netherlands. And obviously this data influences short-term prices immensely, maybe more than anything else in the last half hour before trading. And in Germany, you have a 20-minute delay of this data being published, and 20 minutes in short-term trading, that's light years. That's a very long time. And you have some actors that provide balancing services. So when they get called on these balancing services, they have this information 20 minutes before the rest of the market, and they act on that. So when I think back to my compliance courses, I learned that if you have information that is material, private, and influences prices in a predictable way, and you act on that, that's called insider trading. And this is happening in the market at all times. And especially the German TSOs, by not publishing this data in real time, facilitate this practice. And I think that's very problematic.
Yeah, no, absolutely. Thank you for highlighting that. I think so you would urge them to provide that information to all market participants at the same time.
Very much so. And even beyond that, I would urge the regulator to publish all real-time production data by assets, say, bigger than 500 kilowatts, and production schedules by all power plants. And in Germany, again, look, we have this thing that data privacy is a big thing, and sharing data is a bit scary also due to our past in many ways. But in terms of markets, if that data was published, then we could do a so much better job at running the system efficiently. And the fact that this data is often delayed by a half an hour or an hour is really holding us back from pushing the energy transition to its next level.
Obviously, insider trading is what no one wants, and I think that's a serious issue. But the other one is obviously market inefficiency.
Yes, I mean, on the insider trading side, that some companies are making a bit more money than they should. That's an issue, and I think that's unfair. But the bigger issue is exactly what you said, that if the market has timely and correct data, then it has better information, and then we can steer the grid better, we can steer production assets better, we can steer consumption better, and we'll save a lot of resources and money, and at the end of the day, often also emissions, because if you ramp up an inefficient plant for the wrong reasons, then this is not good for anyone, including the climate.
Yeah, well, absolutely, and I think let's hope that the TSO see sense and put this data out, and certainly we at Montel will be joining your call for greater transparency, as we have done over previous decades. So, Amani, thank you very much for joining the Montel Weekly Podcast.
Thank you so much for having me. It's been a pleasure.